Most buyers believe they have only two choices: buy now or wait. But that isn't actually true. There are several ways to structure a mortgage, and the strategy you choose can matter just as much as the interest rate. I'm Regine Etienne, a mortgage loan advisor. Over the next few minutes, I'll walk you through 3 strategies a lot of buyers never hear about, and how to think about which one might fit your situation. Because strategy is the advantage. Let's start honestly. Affordability is genuinely difficult right now, and I'm not going to pretend otherwise. But the rate is only one piece of what you pay. Your monthly payment is also shaped by the price of the home, your property taxes, and your homeowner's insurance. What you owe on car loans, student loans, and credit cards affects what you qualify for. So does how much cash you have available at closing and what's happening in your local market. And there's one question buyers forget to ask. How long do you expect to stay in this home? 5 years and 30 years point toward very different decisions. So the more useful question isn't, should I wait for the perfect time? It's, what strategy fits my finances and my goals today? Option 1 is to wait and prepare. And sometimes that really is the right call. Waiting may make sense if you need time to build savings for your down payment and closing costs. If your credit could use a few months of clean history, if you're carrying monthly debt that's crowding out your payment, or if your income is new, variable, or self-employed, and you need more documentation behind it. The possible upside is that your financing costs could improve depending on your circumstances. The possible risk is that prices, rent, or competition could rise while you wait. So here's the distinction that matters. Wait with a financial plan, not just a rate prediction. A plan you control, a prediction you don't. Option 2 is negotiating seller concessions. A seller concession simply means the seller agrees to contribute money toward your costs, instead of you paying all of it out of pocket. Depending on the transaction, a negotiated contribution may go toward eligible closing costs, certain prepaid expenses like taxes and insurance, or an approved temporary buydown. The point is that it protects the cash you would otherwise hand over at the closing table. Now, I want to be clear. Not every seller will agree, and not every property or market makes this realistic. Allowable amounts and permitted uses depend on the loan program, the property, the negotiation, and the transaction itself. But it is worth asking. Buyers leave this on the table constantly, simply because nobody told them it was negotiable. Option 3 is a temporary buydown. Here's the plain English version. An approved temporary buydown may reduce your payment during the first 1 to 3 years of the loan, depending on the program. The payment starts lower, then steps up on a set schedule until it reaches the full payment. Let's say it's a 2-year structure. Year 1, your payment is reduced. Year 2, it's reduced by less. From year 3 forward, you're paying the full amount. 4 things to understand. The reduced payment is temporary. That's the whole design. The payment increases according to the schedule disclosed to you at closing. No surprises, but no negotiating it later either. You should be comfortable with that full scheduled payment before you sign. Not hopeful about it. Comfortable. And refinancing may become possible later, but it is not guaranteed, and nobody can promise you that it will be. So a temporary buydown fits someone who can afford the long-term payment, but would benefit from lower payments early on. Which brings me to the bigger point. Don't evaluate a mortgage by the rate alone. When we sit down together, we're comparing the available loan programs, what each one requires in upfront cash, and what each one costs you monthly. We look at your income and how it's documented, your credit and your debts, anything about the property that affects financing, when and whether to lock your rate, and what the whole thing costs over the time you actually plan to stay. Every buyer's situation is different, and loan program guidelines vary. The goal is not simply to get approved, it's to choose financing you understand and can sustain. So, there is no single strategy that's best for everyone. The right answer depends on your numbers, your goals, and the property you're considering. All loans are subject to qualification and final approval. If you're wondering which of these might fit your situation, I'd be glad to walk through it with you. I offer a complimentary mortgage strategy review where we look at your options side by side, in plain language. No credit check or application is required for that initial consultation. I'm Regine Etienne, Mortgage Loan Advisor. Thanks for watching, and I'll see you in the next video. If this was useful, please like the video, subscribe for more, and save or share it with someone who's weighing the same decision.